Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Bhansali was recently among a small group of athletes who achieved the unthinkable, a 135-mile run in scorching heat, wind gusts, and rain, all while traversing both the lowest and highest elevation points in North America. The Badwater 135 is considered the most difficult ultramarathon, an undertaking in which a guiding philosophy is simply do not die. As the CIO of LongTail Alpha, Vinier's investment philosophy is also not to die, or, translated to markets, don't get forced out at the wrong time. And in this context, he makes substantial use of derivatives, instruments that protect against the extreme events that markets all too often confront. Our conversation is a review of the August 5th risk event, exploring its causes and consequences. Unsurprisingly, Vinier sees the overconsumption of the yen carry trade as a primary catalyst, and he details the many ways in which printed, essentially free yen made their way into risk assets of all shapes and sizes. He details how his firm navigated the flare-up, looking to trade VIX at incredibly elevated levels before the open. With a view that the market price of insurance has come back to earth too fast, and with concerns that the recent risk-off may just be an appetizer for a larger unwind to come, Vinier argues that embracing insurance strategies is an important part of a long-term strategic portfolio plan. I hope you enjoy this episode of the Alpha Exchange, my conversation with Vinier Bhansali. My guest today on the Alpha Exchange is Vinier Bhansali. He is the founder and CIO of LongTail Alpha, a firm doing lots of interesting stuff in the options and convexity space. Vinier, it's great to have you back on the Alpha Exchange podcast.
Well, thanks for having me, Dean. I think I was one of the first 3 or 4 people when you first started this, and it's great to see how much attention people are paying to this. It's a great show, and you're reaching a lot of people with very important professional level stuff. So
I really appreciate it. I'm 173 episodes in, and I believe you are the only 3-time guest.
Yes, great.
And I think that's really a function of just how much I value your insights. And the timeliness of this conversation is hard to understate, just given the tumult in asset markets, the spillover from one asset class to another and from one part of the world to another. So lots to discuss on the linkages. And just before we get underway, because some listeners may be newer listeners, tell us a little bit about your career history and then specifically the objectives on behalf of your investors at LongTail Alpha.
I know if I reveal myself as one of the long-term, dinosaurs or the pre-AI era investors in the space. So I've been doing tail risk-related stuff now for close to about 30-something odd years. I started with a Ph.D. in theoretical physics. I finished my Ph.D. in 1992, went to Wall Street accidentally, got interviewed by Fisher Black, didn't work for Fisher, but later found out that my career would be defined by option trading. So I did that in Wall Street at Citibank and Salomon Brothers and other places. Citibank as an exotic options and hybrid options trader. And then after that, Salomon Brothers as a proprietary trader in the famous Michael Lewis book that everybody's heard about or read about. But I was in the ARB group there, did that for multiple years, and then came to PIMCO in 2000, when the market was actually similar to, in many ways, what's going on today with the tech boom and .com and all that. I was in charge of analytics and also started the first hedge fund at PIMCO. Did that for about 17 years. And then in 2015, left to start LongTail Alpha, which basically focuses on risk mitigation strategies, everything that has to do with convexity, pretty much any lever that you can pull. So that's what we've been doing now for the last close to 8 years. And the markets are obviously exciting every single day, every single week, last week being a case in point.
Absolutely. You've had your hands in different asset classes. You mentioned the Salomon Brothers days, and of course, the fallout from LTCM and things like gigantic swap spread widening. You were very active during the pandemic and printed some incredible returns from being long convexity during that insanely tumultuous, if not short-lived episode because of all the intervention. So we're going to really focus on this last week, the causes of it, the implications of it, what we can expect going forward. Before we do that, I can't help but wanting to talk a little bit about your recent accomplishment, which is just tremendous. Just reading your piece in Forbes on the Badwater 135. So you've just run a 135-mile race, which in and of itself is kind of absurd. I ran a half marathon back in December and I said, I'm done. That's about all I'll do. So it's a tremendous, almost unfathomable accomplishment. But the set of circumstances around this particular run with respect to heat and elevation are so unique. Just take us through exactly what Badwater 135 is. I understand it was, I think, 65 entries and you got to finish in 48 hours. You finished in 40 hours. So just tell us a little bit more about it.
Ultra running is, one of those things that I've been doing now. Well, I started late, so I guess I still have legs, but over the last 17 or 18 years, I've done all the big ultras, Western States and UTMB, Ultra Trail du Mont Blanc and Angeles Crest and Leadville 100. And it really gives me a lot of time to think. And the training itself is a lot of fun because it gives me a lot of time to what I call work, because it allows me to process all my ideas without the constant interruption of emails and cell phones and market data and all that. So partly it's mental. Actually, most of it is mental and some of it is physical. And Badwater is one of those very exclusive races around the world where you have to have done at least 3 to 5 of the largest, biggest ones in the world. And you actually have to apply and get invited. And it's very hard to get in. And part of the reason is they really want people who get in to be pretty experienced because you're running in Death Valley. And Death Valley is recorded as the hottest place on Earth. The race starts at Badwater Basin, which is 285 feet below sea level, and then climbs over 3 big mountain passes and finishes at Whitney Portal, which is about 8,300 feet. This leads to Mount Whitney, which is the highest point in the continental United States. But it's 3 pretty ambitious climbs. And I'm a trail runner. For me, the biggest factor that required a lot of training was getting used to running first on the road. Secondly, the heat. It is incredibly hot. When we started, it was about 125, 126. I just found out 2 days ago, according to one of the NASA satellite reports, that July 22nd and 23rd, 2024, were the hottest recorded temperatures on Earth in recorded history. And July 22nd and 23rd was the race. And didn't break the Death Valley record of 134, I think, from 1917, but got very close to it. It was in the high 120s, and it was storming. I started at 8 p.m. on Monday night on the 22nd and ran through all night the first night, all day the next day, where the temps were about 110 to 120. And the crew is basically cooling you down with ice and water, and you get massive blisters from all the water and rubbing and friction, which I do have today. I'm recovering now. And then I ran through the second night and I finished right before noon on Wednesday. So 39 hours and 46 minutes. My target was 40 hours. Because it's an invitational, everybody's quite experienced. They only allow 100 runners and 97 started. And because of the incredible heat and wind this year, only about 72 people finished. And I was 45th, I think, overall. My whole goal was just to finish in one piece. And I managed to do that. But the piece that you're referring to, Dean, is in the length of 39 hours of just moving forward. You reflect on life and reflect on your profession and how the two things kind of have a parallel. And the thing is, there's a lot of similarities. It's very much like investing. It's very much like investing for the long run. And there are always intense moments. One of my crews, who's an elite runner, said there's moments, and the moments that my friend Charlie Engel, he suggested are high moments and low moments. And in markets like last week, last Sunday, you remember those high and low moments. And if you have a plan, and the plan can be of many kinds in terms of portfolio allocation, using hedges, using options, using instruments, using derivatives, then you can actually manage those moments and you can actually come out on the other side in one piece or even better than one piece. So there's a lot of parallels to long distance running, especially ultra running in intense conditions and being in markets.
You mentioned in your article, which I really encourage listeners to access on Forbes under Veneer Bhansali. This one's called Badwater 135.
It's also on our website, by the way, at longtailalpha.com. If anybody doesn't want to pay the Forbes tax, you can just get it from our website.
Better place to get it. You mentioned getting to the 100-mile mark, around there, and that being the previous length of a lot of these ultra marathons, and then having 35 miles left, and that almost being a breaking point for you. Tell us just a little bit about that.
So your body and your mind get conditioned. And that's very similar, again, the parallel to investing. We have all seen events in our history and in our past where we're conditioned and we know sort of how to react to them. But the world changes. And in this race at a 100-mile point, I've done a number of hundreds and I'm pretty used to them. Like at mile 90 or 95, it's like, oh, I feel like I've gone through the cycle and I am going to be done here. Your mind is saying, no, you still got 35 miles to go, especially the hardest 35, because the race finishes with a big 4,000-foot climb up to Whitney Portal and these really steep switchbacks. But your body is trained and used to what you've done. So at 100-mile point, I'm like, okay, well, I'm going to be done here. No, you got a 35-mile, i.e. a 50-kilometer race, the hardest section at night, very monotonous, just long rolling roads and a big climb still ahead of you. And at this point, given the heat and the friction, my feet were basically in tatters. I could feel that the skin was coming off. I wasn't the only one. And I still had to somehow survive. Now, guess it, right? You're not moving that fast at this point. You're moving at best 4 miles an hour. And so you still have about 10, 12 hours left before you finish and 35 miles to go. It is a lot of inclination to just give up, like in markets. If you are getting close to retirement or you've spent a lot of time accumulating money and you're 5 or 7 or 10 years from retirement and the market's tanked, the inclination is to throw in the towel and just exit and go to T-bills, which may or may not work if inflation remains high. So you kind of need to keep moving and you kind of need to be in the race. Part of the reason I wrote that piece is because the parallels suggest that if you think it's time to kind of give up and just go to cash, might be the best opportunities out there and might be the best. And it turned out my wife was my pacer actually towards the very end. And I'm not an elite runner. She and I actually finished the race in a third fastest time recorded because we had managed my whole 40-something hours very well. So I had it left. And again, if you have managed your portfolio's risk well, then you have the option, you have the alternative, you have the choice that you can do those last few years or the best parts of your investing career in a better form and fashion than if you didn't have those things already planned.
Well, you mentioned in that article, your piece, some mantra, maybe it's from ultra marathons in general, but perhaps it's very specific to this run, Badwater, a mantra of don't die. That's your goal. And then you make this analogy to markets, which is don't get forced out. That's sort of the death, is the very untimely unwind. And I think that sort of speaks to, I think, a lot of your philosophy, and I think my own as well, about the value of really, really trying to imagine and plan for the unexpected. Markets are kind of never say never. That's the world of markets. I think we got a little whiff of that last week. And then another statement you make, and this I think is where we can shift to reviewing what's happened and the implications. You make the statement that markets are simply not prepared for regime change. And I think that's spot on as well. You shock a market from, let's say, a very low vol environment. Well, what happens in that environment? Trades get built around the expectation that it'll continue ad infinitum. And then the shock makes those trades really, really vulnerable. Why don't we get started there with how you would describe the setup going into, it's probably more right to say it's the end of July. I mean, you might even go all the way back to, in my view, the US CPI day. Benign day, kind of gave the Fed the right air cover to say, okay, we're basically ready to get started on this easing campaign. And then the soft NFP really solidified that. So it was not just August 5th, it was building into that. I'd love for you to give us the setup, describe from your vantage point what you saw in the preceding 2 weeks or so going into August 5th.
Markets and humans have a tendency, like the long race, to remember the highs and lows, but also to get conditioned to your current environment. And we start to think that the most recent things that we're seeing is normal. And in this particular case, we can point to one or two data points, which is the good inflation numbers and weak NFP, which basically convinced the market that the Fed would have to cut rates. And indeed, next month, they'd probably end up cutting 25, but maybe with some hawkish language just to keep the markets under check. But I think you have to go back, not just the 2 weeks. You have to kind of go all the way back to the 1980s and 1990s, because in my view, these cycles, the long-term cycles of money movements, play out with a very predictable rhythm and rhyme. And as you get used to participating in the markets, you understand the ebb and flow of these long cycles. So if you go back to the real estate crisis in Japan, where easy money and speculation resulted in a massive increase in real estate prices a few decades ago. And then, of course, the real estate market collapsed. And that then led to Japan ending up in a almost, call it 20, 30 years worth of deflation and low interest rates. And the reason I start there is because what's happening today, what happened 2 weeks ago, is, in my view, just a marker. It's a milestone, a moment, which will determine what will happen over the next maybe decade or 2 decades, because we are in a specific regime whose origin goes back to the bust in Japan that resulted in low interest rates. So we have to understand how we got stuck in that regime, now how we're coming out of that regime. And locally, markets are very rational. Every participant is very rational. So the reaction function in the short term of individuals and individual investors is very rational, because everybody does it for proper risk management reasons. But when you step back and look at the collective whole, you start seeing these mega patterns, which I'm going to get into now, which is why I believe that what we saw last week or last month was not the last of the story. Maybe it was just the first little rumbling in an earthquake that might trigger some bigger fault line. Living in California and knowing earthquake geology, I kind of have to bring into that analogy as well. So going back to Japan, so you have this crash. Japan has to cut rates aggressively. They try to raise it a few times, doesn't quite work. So they cut it. They actually take interest rates negative. They were the first ones who came with this basically economic philosophy that if low rates are good, then negative rates are even better, which then the ECB adopted and many other countries adopted. It is a dogma, quote unquote, that really took place in Japan. And in my view, people don't know this, I'm a physicist, there's a big difference between negative interest rates, zero interest rates, and positive interest rates. These are 3 different regimes. These are 3 different phases. When you have water, you can have ice, you can have liquid, and you can have steam. These are 3 different types of things and 3 different types of environments. Low interest rates in Japan first resulted in some investment in productive assets within Japan. But then those low interest rates resulted in Japanese investors, their institutions primarily, going into foreign countries. So GPIF and Postbank, who are effectively the largest investors in the world today, went out and started accumulating bonds globally. And by any standard today, the bond holdings of many of these Japanese investors is the highest, probably as high as China. And they're huge holders of foreign bonds and foreign equities for that matter. But foreign equities started a little later. So foreign bonds, now, if you think about it, you can print money at zero or negative. You're getting paid to print money. And you buy these bonds. It's actually quite attractive because for all practical purposes, you can bring an annuity. So if your own population is getting older, it's not as productive, and you're under a deflationary cloud, so to speak, then you can effectively print money, yen, and you can buy dollar assets, you can buy euro assets, and so on. Initially, the buying of these bonds, trillions and trillions of bonds, was done in a defensive manner. It was done with currency hedging. So you buy a US dollar bond, you're a Japanese investor, you're taking US dollar risk. So to hedge it, you basically have to go out and sell the dollar. So you can sell the dollar using a currency hedge. As soon as you currency hedge, you've kind of taken 2 different trades onto your book. The first trade is that you have bought a long-term or even an intermediate-term US bond, and you're effectively financing it with the short-term interest rate in Japan. So you've taken kind of a yield curve bet across two different countries. Then secondly, when you come in and you immunize that currency exposure, you are using, typically the currency hedges are short dated in nature. They might be 1 month forward, 3 months forward, and if you're lucky, maybe a year long forward. Okay, so if you do a forward, now you're effectively converting your currency risk using these short dated currency swaps into yen. You're selling the dollar forward to hedge your dollar risk, and you're basically receiving yen on the swap. So now what you've effectively done is you have taken two different kinds of carry trade risks. And this is extremely important because this is, in a nutshell, the inner reason why we had this mega meltdown on Sunday night. So you're running a term structure carry trade, long bonds, long-term assets versus short-term funding, and you're running a cross-currency carry because of dollar and yen. So this works really well as long as the two yield curves are sloped kind of similarly. And I wrote a paper about 10 or 12 years ago on this topic, was published in the Journal of Fixed Income on the deep relationship between this carry trade and currency volatility, which I'll come to in a second, with all the math and so on, if anybody's interested. The problem is that recently, the US and Japan have gone in different directions. Because the central banks fell behind the curve, US short rates went up really sharply. Japanese short rates did not go up, they were still negative. So the short-term currency differential was almost 5.5 or 6%. Now, this is extremely important because if you are a Japanese holder and you're buying US dollar bonds, and that short rate differential is that high, by purchasing power parity, your currency hedge, which is only 3 months or 6 months in expiry, is actually going to cost you more carry, 5.25% minus the yen, which is negative 0.10, plus the basis swap. We're not going to get into the technicalities of the cross-currency basis swap, which is demand and supply. You're basically losing 6.5%, 7% on hedging costs. So it makes no sense for you, if you are a large investor, to hedge your US dollar bond holdings. And that's basically what happened. And you can see in 2022 or so, it was a big inflection point. A lot of bonds that were bought by Japanese investors, including retail investors, including the institutions, were now being bought on an unhedged basis.
How do you see that? Is that available in CFTC data or?
Not CFTC because that's exchange traded, but if you go and look at BIS data, and there was an excellent report that I read a couple of days ago from one of our dealers, which actually aggregated, and they said it's approximately 3.5 trillion. The total amount of the carry trade that's out there from retail investors, from institutional investors, about 4 trillion in size in US dollars versus yen. But 3 to 3.5 trillion is actually in this total, they think possibly half to more than half currency unhedged basis. And it really picked up in 2022. So we can see that inflection point in the charts. I'll send it to you, Dean. I'm not sure if that's something we can post, but for your reference, you can look at the data and see that inflection point where the Japanese investors started to run their bond portfolio and to a high degree, their equity portfolio. What's an equity portfolio? You're funding with short-term interest rates below zero, and you can buy these massive mega cap stocks that are bigger than the bond markets in most countries. NVIDIA, Apple, Facebook, et cetera, et cetera. These stocks are massively large cap, trillions. So you can buy these stocks. So as a large institutional investor who has to participate in global equity markets, you can buy US mega caps. And you don't need to hedge them either because they are going up at the rate of 10% a day. A little bit facetious, but they can go up that much. So you fund money at negative 0.10, and you can buy US equities that can give you 100 years worth of income in one day. Why wouldn't you do it? Because the money that you're printing is effectively a highly levered country's money. Japan, big debt to GDP ratio, big holdings of fixed sector debt. Effectively, as I call it in my, somewhat jokingly, but it's funny money, it's monopoly money that you're printing, and the world is allowing you to take this money to buy mega cap tech stocks or treasury bonds, full faith and credit of the US market.
With the risk, of course, that there's a sharp change in the profile of the currency.
That's the second part of the story. So that's the Japanese investor. Now you've got US investors. So when Warren Buffett started to buy the Japanese banks a couple of years ago, and there was this whole talk about the governance changes and so on in the Japanese stock market, a lot of US investors, a lot of foreign investors went to the Japanese equity markets. The numbers that I hear are close to about between 60 to 100 billion in fund flows into Japan. Now, remember what they're doing now. We talked about the Japanese investors buying US assets more and more on a currency unhedged basis, i.e., being exposed to currency risk. Currency risk here being a stronger yen, a weaker dollar hurts their total portfolio. US investors are doing the opposite. They're buying Japanese equities, which are now back into fashion, the resurgence of Japan. They are actually on the same side when it comes to hedging. They are also selling the yen because when you buy a Japanese stock, you don't want to take the currency risk in Japan. You sell Japanese yen, you buy US dollar. That's how you currency hedge. So you can now see that everybody is running a big dollar long, whether it's on a hedge basis or unhedged basis, or a yen short. The yen is a funding currency. Yen has weakened from 100 to 165. One clientele, Japan, is not hedging their risk in the currency market. The US clientele, quote unquote, is hedging. And I'll throw the last piece of this puzzle and then put the puzzle pieces together and kind of paint the composite for you. If you are a Japanese bondholder and you bought a US Treasury bond at, let's say, 1% yield, which was 2 or 3 years ago, and now your currency hedging costs are 6.5%, you have two choices. You're basically upside down. You're losing money on the bond relative to your hedging costs. You have two choices. You can sell the bonds and take the losses immediately, or you can decide not to currency hedge. So there's a huge incentive for you not to currency hedge if you're a Japanese investor, because otherwise it means hedging and losing carry on a bond holding that has been marked down 20 to 30 points. So nobody's taking the losses today. And so you are forced into a corner where you are not hedging because that's the only way you can even realize that carry that you paid for very expensively a couple of years ago. On the other hand, the US investor, the risk is if the Japanese market tanks or if the yen becomes stronger, they have to readjust their hedge. They have to actually start to lower their dollar yen hedges because the value of the equities is lower. Okay, so now we have all the pieces of the puzzle here put into the picture. So now we can explain what happened somewhat into last Sunday night. Let's come back to where you started, Dean. So you've got a weaker inflation number, a nice payroll number. Fed's going to cut rates, 25 basis points, maybe 50. The market's saying, okay, September is a done deal, maybe 100 basis points for the rest of the year. At the same time, the Bank of Japan looks at their inflation rate, which is running between 2 and 4%, depending on how you count it, is almost 400 basis points higher than their short rate. So they have no choice. So they have to raise rates because otherwise the yen gets weaker and weaker and weaker. And at some point, the people who own these assets are going to start complaining that, look, yen's weaker. It's great for the exporters in Japan, but it's really bad for the folks who are basically exposed to that currency market weakness. So there's a lot of noise inside of Japan that, look, you got to do something about this currency. So, of course, the BOJ does what it has to do. It goes in baby steps from negative 10 first to positive 10 a couple of months ago. This is their overnight call rate. And then a couple of weeks ago, they go positive 10 to positive 25. And they also say that, A, we're not going to be buying JGBs as aggressively. They're the biggest buyers of all their bonds. And maybe we'll start to hold back on the equity purchases in Japan. They're also the biggest equity buyer in form of ETFs in Japan. So basically, the bid is gone, as we say. There is no bid. So you have Japanese rates coming up, US rates coming down. That reduces the benefit of owning the yen. At the same time, the BOJ is not going to be buying their equity markets, scares the US participants. At the same time, they are now promising that they're going to raise interest rates to keep up with inflation, a perfect storm.
What's fascinating, and markets just teach us lesson after lesson, but it was always the narrative that Fed tightening in the face of central banks like Japan, let's use that as the prototype for an economy stuck at zero ad infinitum, Japanification. That was the risk, that the US exporting its tightening was going to be destabilizing. And here, you're really describing the opposite, which is really fascinating. All of these things evolve. We take in the data and then we react to the data. So as you said, Japan, they went 10 basis points, then 25, and the rhetoric was more hawkish. And they're getting inflation data. We're getting inflation data, growth data, and so forth. Is there a scenario in your mind in which we get a repeat of this exact same thing where, let's just say, growth weakens in the US more than expected, and the Fed does more than expected more quickly, and Japan does the opposite? Is the setup cleaned out from the carry trade, or is this something that could repeat itself?
You kind of hit the nail on the head here. So what's priced in is the tightening in the US is bad. And we know that that hasn't quite worked because short rates have gone up 500 and long rates have barely budged. And the markets are just rallying. They're ripping higher because, again, what happened during COVID was money got printed, then money got sent to the mega caps. Mega caps made huge cash reserves, and their net income situation is actually better now because they're recycling their profits into T-bills, earning 5.5. The U.S. Treasury just paid out about $600 billion worth of interest income to depositors, including the mega caps, and they're just buying their stock back. So what's priced in, or what people know from traditional economics, is that short rates rising should result in a slowdown of the economy. But people forgot this thing that we just talked about for the last 10, 15 minutes, is that the system itself is extremely levered to exactly the opposite phenomenon, which is an interest rate differential globally between Japan and the US. And any normalization of that interest rate differential is a bigger magnifier for volatility than any short rate increase. The market is immunized to short rate increases at this point because of the capital situation of the large companies. But the market is completely unimmunized and not even ready for rise in Japanese interest rates from negative to positive. And that's the phase transition. So going back to the race, I was prepared very well mentally for the distance, for the road, and for the heat. But guess what happened at the start line? Thunderstorms. The first day, the hottest place on the earth, one of the driest places on earth, I was not prepared for rainstorms and thunder and wind. It's like, where did this come from? And that's very similar here, is that this small change in interest rates in Japan and small reduction in expectation in the US created absolute mayhem. Here's how you connect the dots. What is the mayhem that happened? It was complete evaporation of liquidity. So Sunday night, I have been conditioned for the last 30 years to wake up at least twice a night and check my Bloomberg. I just do it, except when I'm on vacation. And at midnight or 1 o'clock California time, I looked at it and Nikkei was down about 12%. And I texted our team and said, hey guys, I think we're going to have some opportunities for monetization in the morning. So we were in the pre-market with our algos, basically. And when the Nikkei was down 10, 12%, one of the dealers sent us a report on the depth in the Nikkei futures market that night. It had completely evaporated. It was worse than the worst time during COVID. JGB futures, same thing. Japanese yen futures, again, the futures market is only a small part of the currency market, but very low liquidity. So you could barely trade. You take that complex and now combine it with how many people need to possibly get out of it. So the culprits that people mention are CTAs. Everybody net long equities, especially Nikkei futures, because Nikkei's rallied so much until last week that everybody, all systematic guys, got drawn into it. Low volatility, rallying, trending upside markets, everybody was in Nikkei. Secondly, risk parity. Low vol in equities, VIX hit about a 12, drives people into risk parity type of portfolios. Everybody, risk parity, vol targeting, max long equities. Macro people trying to chase mega caps, everybody long equities. So you have a max long positioning in the equity market, and you get this illiquidity. You come in Monday morning and you found a complete breakage. The VIX index was at 65, the VIX futures were at 30 something, but you could barely trade anything. To kind of summarize what happened there on the weekend is that we realized very quickly, we meaning market participant, is that it looks like we have a lot of liquidity. It looks like it's all good. But actually, when push comes to shove, the ecosystem has changed so much that there is no liquidity. And until this morning, the E-mini futures depth was probably about as bad as it got during COVID. And that's why you're seeing these, massive moves, 3, 4, 5% moves, as everybody is now coming back into the market. Everybody who tried to de-risk, maybe de-risk a little bit, is saying, okay, VIX index is down at 15. The measure that people use as an indicator to scale their bets is now telling the models to basically re-risk. So everybody's coming right back in.
Vol as a statistic we look at, and vol as a direct input that is mathematically scaling in and out of exposures. I think that's a new thing. And then you point to this idea about liquidity. Ilarian used to say, liquidity is a mirage. He was sort of referring a little bit to liquidity transformation of essentially buying stuff that's illiquid with shorter dated, let's say, funding that could get pulled. That's the repo risk. But the mirage of liquidity, I think that you're referring to, is a little different. It's electronified liquidity can look really, really impressive because that electronic engine, that algorithm can pull away instantaneously. You can be real tight and you can be real active in price discovery if your decision making is instantaneous to just pull away. The thing that I've always asked myself is, at some point, the people writing this code, they're all kind of picking up on the same thing. And so if their pain threshold, where the formula senses, hey, this is new, this is different, this is not the same regime, and we're going to pull away, if there's correlation in that decision, then you have the vacuum. And I think there's some version of that that we probably just experienced.
I think it's exactly right. And I think what is happening, I call it the mega store Amazon effect, is when they come in and they cut prices, they initially make it really good for consumers. They basically eliminate the small mom and pop shops and people who effectively provide you with that kind of robust underlying market. And once those small shops are gone, then it basically is a monopoly that depends on these one or two large providers in your hometown, or the Amazon effect, if you want to call it that. And that's sort of what has happened to the derivatives market. I've been doing this like you have been doing this for about 30 years. And in the old days, it used to be who was on the top step of the exchanges and who was on the bottom step. And one human could take a lot of size from a dealer and literally turn the market around on the exchanges. We've all heard about Tommy Baldwin and others. When I was first started trading bond futures, I mean, you basically get stories about this giant of the pit trading who would basically stop the market and turn it around, because humans have a tendency to bet on mean reversion when things get to extremes. In the last 10 or 12 years, algorithmic trading has resulted in algos who don't really have those kind of emotions to basically optimize for their own profit. And like you were just mentioning, Dean, when they see a surge coming and there's a signal, like if I'm up at midnight and knowing that there's no liquidity in the Nikkei futures, I know because of the interconnectedness of markets that rising Nikkei vol is going to translate into rising global equity index vol, is going to result in rising VIX vol, will result in de-risking from these trend followers and risk parity and vol targeters and macro managers. And the tsunami is coming. Get out of the way, turn the algos off. Market depth just completely evaporates and there is nobody there. So what happens in that situation? I talked with my team because we were able to monetize early in the pre-market a fair amount. And the idea is not to trade or put your trades in like you would in a typical algorithmic fashion where you show a little bit of size, you trade the bid-ask bounce, and then you show more size behind it. When the algos are gone and it's mano a mano, it's person against person, it's two humans, anonymous, but making decisions, you have to show size to get that size cleared. You show size, somebody sees it and says, there's size there, I can get my trade done that I need to get done at that one price. And that's alive and well. I saw that last time during COVID. I saw that last week, Monday and Tuesday. It was very much a human trading market. Mohammed calls it a mirage of liquidity. I call it latent liquidity and liquidity. It's there, but to harness it, to harvest it underneath the surface, you need an approach that is extremely primitive by today's algorithmic standards.
There's a veritable smorgasbord of risk asset prices that changed dramatically. I mean, stock bond correlation went massively negative. Parts of the US yield curve, 3-month, 2-year, disinverted by something like 30 or 40 basis points in the course of days. We had 2 cuts fully priced. For me, the VIX is 65, the VVIX 180 were crazy. Break evens plummeted by 25 basis points. Yen vol got to 21, the short dated 1-week yen vol. Anything that stood out to you most is the first question. And then let's just finish with where you see things now. And obviously, you have a view that this could just be some appetizer for future disruption. But of course, the prices of these insurance contracts, it's critical. Getting the price right, the entry price, is a big part of it. And we were talking about how quickly the VIXs decline, which to me is music to my ears. So first question, just in terms of the violence of the moves, anything that kind of wins for you in terms of, wow, that shocked me the most?
I think what shocked me the most was the incredibly fast and furious sell-off in the Nikkei, followed by the fast and furious rally in the VIX. I wrote about this in another piece. Back in the 2000s, it used to take quarters for things to spike and relax. And then in 2008, it took maybe a few months. And then during the Volmageddon, it took a few weeks, then it took a few days, and now it took a few hours or minutes, if you want to call it that. So the intensity is getting compressed into a shorter period of time, and the decay is much faster. So if you take that speed, what sticks out to me is basically 3 things. One is that our approach to portfolio construction, portfolio management, monetization, et cetera, has to match the time scale at which the markets are reacting. If you wait for weeks and months, you're not going to get a chance to do it. Secondly, you have to have a plan. You have to have a plan in advance and be ready to do it, whether it was the Nikkei market that was astounding or the VIX futures curve inverting or the yield curve. There is so much money in the system that it is going to take the first shot at taking the other side when there are extreme moves, which is, I think, what happened. If you step back from it and go to the second part of your question, okay, so what happens now? If you take my numbers, which I think come from fairly reliable providers, if there's a 4 trillion worth of carry trade that's out there, and maybe in this sell-off, let's just be very, very complimentary and conservative to the liquidity episode, let's even say 500 billion got out, which I don't think it did. There's still about 80% of this carry trade that has still not been done well. Currency carry trade, maybe yes. The Nikkei carry trade, maybe partially yes. What about the credit trade? What about the vol selling trade and so on? It hasn't been cleaned out. So what that leads me to is what happened? Why did we reverse so quickly? And again, it goes back to the decisions of 1 or 2 or 3 individuals. So it was the deputy chief of the Bank of Japan who came out and said in some talk saying, when the markets are volatile, we will not do tightening. They have just given you the recipe now for what you got to watch for. If the markets start to rally from here, then their statement is consistent with them doing the next 50 basis points or next 25 basis points. And I think you have to be prepared for the market to react in an even more vicious form. Because like you and I are having this conversation, I was with some Japanese investors a couple of days ago in New York, and they're all looking at it and they're saying, what happens next? How do we get ahead of this now? So that next time around, if the market, the Nikkei falls 10 and 10 and 10, instead of going 10 and going up 10, we don't get completely stuck with our bad position. So today, like you said, Dean, and I agree with it, the fact that the VIX spiked showed us where the fault lines are and has come back down gives you an opportunity to basically robustify your portfolio. Either you de-risk based on the stress shock that you saw, or you buy options because optionality is again on sale. And going back to the last 4 or 5 or 6 crises that I've been part of, the market always knocks once, twice, thrice, but then it doesn't. Then it'll basically punish you for not listening to it. And I think we just got an alarm bell, and we're getting a second opportunity to robustify our portfolios. And if you don't do it now, you can't look back a year from now and say, we didn't get a chance. You are getting this chance.
Once we have an event, as you recognize and you properly state, you get this spike in the VIX. It goes up faster than it comes down. In this case, it came down incredibly fast. And I do agree that the decay is, the timeline is shortening. This one was really short, but it's probably the case. I always say probably. I'll never say anything with a lot of confidence in markets. That's the humility you have to have. But it doesn't feel like the 12 handle that we had experienced maybe a couple of months ago is at hand real soon. So even as insurance costs have come down a lot from those recent highs, it's unlikely they're going to get back to where they were. And so I'd love for you to just frame out the balance of that you've had this shock. There's information about instability in the shock. The US economy at least could be in a path here where the Fed overshot in terms of keeping the policy rate too high. How do you balance the system does feel less stable than it was? I've got some new information on hand, but I have to pay up a little bit more for the prices of the convexity instruments that I want to own.
What happened last week is possibly some people thought this was the tsunami, this was the crash, and maybe they overhedged. Maybe some of what we're seeing is not just monetization and liquidation, but just people reversing those positions. And it's too murky right now to tell whether 65 was the high or 15 today is the low on the VIX, or maybe it gets back down to 10 because of positioning. But what it does tell you is one thing, the VIX moved, right? It oscillated quite a bit, but long dated hedges, if you think about 1-year options, 2-year options, the CDX barely budged. During the height of the crisis, the CDX index went from 52 or 50 on investment grade at the lows to maybe 65 or 66 at the peak, and the market was watching. The market was watching when the equity cash market opened up. The cash market did not follow what had happened in the overnight and the Nikkei and the VIX futures market. So the market just settled down and the credit market is sort of relaxed for the time being. I think what that tells you is that if you believe that a regime shift that could be longer, a 4 trillion exit of the carry trade is not just going to be in currencies. It could be in equities, it could be in bond markets globally, and so on. If that happens, you need to not just do a short-term hedge, but you need to do a longer-term planning for it. And the long-term pricing today of the credit markets is actually back to all-time lows, almost at the lows pre-financial crisis, COVID lows, and so on. So it is possible if you step away from this idea that being in mega cap, large 7 momentum stocks is the only way to make money, and put the longer term picture, full circle back to the Badwater race, is that the idea is not to be a winner at the 50-mile point or the 70-mile point or 90-mile point or 100-mile point. The idea is to actually finish the race to the 135-mile point. Then it tells you that the longer term asset allocation is what you need to do, which basically means that today you have the opportunity to create that robust long-term asset allocation. So VIX might not come back down to 10 or 9 or 8, but a lot of other indicators, a lot of other tradable instruments, and by the way, VIX is not tradable, as we all know, but other instruments are back to those all-time.
Yeah, it's a great point on credit. Credit spreads really didn't participate all that much in this risk-off, and this risk-off was much more of a financial, technical unwind rather than something that had at its heart the durability of the U.S. economic expansion and corporate credit risk. And so the prices of those trades, many of which are long dated, 5-year CDS type stuff, is pretty sweet. It's pretty tight. So it's interesting. Well, Veneer, this has been amazing to catch up. I really appreciate you taking my ask to do this on short notice. I knew you were in a great position to inform us about this. Congrats on the marathon. My understanding is you ran this marathon for charity called Laura's House, which is a organization focused on trying to help those who are victimized by domestic abuse. Tell us a little bit more about that.
Thank you for bringing that up. So my wife is a lawyer and she's a volunteer, and she works for that organization. It's fairly underprivileged people in our area here locally, helps them out. The other charity that we do contribute to is our local food bank, which again goes all the way down to grassroots, tries to get cans of food and deliver them to people who are in need. So all of those things, again, nothing much to advertise about, but those are good causes, and both me and my wife and our family supports them and feel fortunate to be able to indirectly help them out a little bit.
Well, congrats to you. It's a tremendous accomplishment, and I do hope you recover well. So thanks again, Veneer.
Thank you very much. And thanks for bringing me on, Dean. And love listening to your podcast. Keep doing it. And definitely when I was heat training in 190 degree sauna, one of the things I was listening to before my phone would go out on a blink was your podcast. So thank you for that.
Fantastic. Thanks again.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.